Welcome to Alternative Realities. I'm Aaron Mulvihill, Global Market Strategist here at JP Morgan Asset Management. It's been a challenging time for parts of the venture capital and growth equity industry lately. Exits are slower due to economic uncertainty, borrowing costs are still relatively high, and investors are choosing their targets more carefully. Yet the huge breakthroughs in AI and other technologies are creating really compelling growth stories. And investors not involved at the startup and growth phases, while these companies are private, can miss out on the massive creation of value that happens at this stage before they IPO on the stock market. Blink and you can miss the growth of some of these companies that are going from zero to unicorns at an incredible speed. I'm thrilled to be joined here today by Paris Heymann. Paris is co-managing partner of Growth Equity Partners at JP Morgan Asset Management, and he has an incredibly impressive career in venture and growth investing. In this episode, we'll talk about a number of themes impacting venture and growth investing, how venture capital is adapting to longer holding periods, how to think of valuations and pricing in this environment, how AI is changing the game, and the impacts of public and private markets converging. Let's get started. Paris, thank you for joining us on Alternative Realities.
Aaron, such a pleasure to be here today. Thank you.
So before we dive in, can you give our audience some background on your career and just the journey that led you to your role here at JP Morgan Asset Management?
Yeah, absolutely. I've spent the better part of the past decade in the technology investment space. Prior to joining JPM, I was at Index Ventures, a multi-stage venture capital firm with offices in London, New York, and San Francisco. Prior to that, I'd been at organizations like Arena Holdings and Bain Capital, and I've been fortunate enough to be an investor in companies like Databricks, Wiz, Figma, and ServiceTitan, among others. So I've really sort of been a part of this space for some time. And I think an organization like JP Morgan has an amazing role to play in the technology space. We purchase $18 billion of technology across the organization. And of course, we have $1 trillion public equity book. So I really thought about the opportunity from the lens of an entrepreneur. Who would I want to partner with if I was one of these entrepreneurs building a company? And JP Morgan, for me, really bubbled to the top of that list.
Well said, and we're very glad to have you. So
yeah, it's a pleasure to be here.
Private equity, if you look at it as a continuum, right? You've got venture capital, growth equity, and the larger private equity space. How do you look at that continuum as an investor?
Yeah, I think historically there were really clearly defined lanes between these different asset classes, so to speak. I think historically the way that one would think about venture capital is you're really investing in people, right? You're investing in an idea. The company may have a product or maybe pre-product or pre-revenue. And the whole concept behind investing is you invest in a broad number of these companies, and many of them may not work. They may not develop into viable commercial entities, but the ones that do have a lot of potential. And because you're one of the first investors in the cap table, those can have outstanding financial returns. I think growth equity has always been at the later stage side of things, where you're investing in companies that have proven business models, they have product market fit, and it's really about capital to scale the business. Often, if that's an enterprise company, it can mean hiring account executives and going to market with your product. If it's more of a consumer-focused company, often growth capital is all about acquiring users, potentially via SEO or digital marketing. And then private equity, I think about as even later stage than traditional growth equity. In the past, a lot of private equity firms have acquired companies outright as opposed to becoming minority investors. And often they're employing the use of financial leverage to sort of change the capital structure of the companies they invest behind. That said, the one rule today is there are no rules. It feels like all of the lines are blending and a lot of different investment firms are trying to participate across the entire spectrum. We're seeing venture capital firms that are doing full buyouts of companies and transforming them. We're seeing buyout organizations enter growth and venture. And we're seeing venture firms write substantial checks in companies that are potentially still pre-product and pre-revenue. So we're seeing a very dynamic organization relative to what has historically been, I would say, more narrowly defined.
Yeah, and I'm sure technology is a big part in driving that, and I want to get back to that later on with you. But first, when you look at maybe that venture growth side of the spectrum, are there any trends that you're seeing taking shape lately?
Yeah, I think, the most important one for me is when I think about it and step back, the private markets are developing exponentially. I think the data that I would point you to is there's a list called the Forbes Cloud 100 list. That's really the 100 most preeminent private technology companies. The list was first published in 2016. And if you add up all the market cap of that list at that point in time, it was 99 billion. Fast forward to 2024, and if you add up the market cap of that top 100 companies list, it's 820 billion. So the list has grown 8x, from 2016 to 2024, which is phenomenal growth. When you look at 2025, the list hasn't been published yet, but we know the top five companies alone are already approaching nearly 600 billion of market cap. So that's almost the size of the entire 2024 list, just of the top five private companies in 2025. I think that type of growth, it's not, incremental. It's really, step function growth in terms of the size and scale of the private markets. I think that's changing the entire landscape, and we can talk about sector-specific theses and changes on a sector-by-sector basis. But when you step back, the opportunity in private investing is just immense, and it's growing exponentially.
Yeah, it's really incredible the type of numbers you're putting out there. So we'll be looking forward to seeing that list when it comes out later this year and seeing who's on it and what it's going to add up to. And just on that, I'd love to explore a little bit more that theme of private and public markets converging, right? So you've got these companies that are choosing to stay private for longer. As you said, they're creating just immense amounts of value while they are private. And so investors that are not exposed to them at that stage are missing out on that value. And then they're IPOing at, unicorn multiple valuations. How do you look at all this? Is this a trend that you see continuing? Are these companies going to stay private for much longer? Are they ever going to go public?
Yeah, I'll take it from the investor lens first, and then let's talk from a company specific lens. At the risk of sounding, controversial here, I think it's going to be really difficult to be an effective private market investor if you don't have public market capabilities, investment capabilities. And similarly, I think for public market investors, you have to have an eye on the private markets and really understand what's happening there. So I think this convergence trend is for sure going to happen for investors that want to capture alpha and generate outsized returns. It's going to be very difficult to title yourself as just a private investor or just a public investor. Certainly, there's going to be convergence of the two. As it pertains to the companies, we're seeing tremendous amounts of value creation in the private markets. I do think that there's going to be a nuanced and balanced approach for entrepreneurs and management teams. The ones that are succeeding, that have large addressable markets, that have strong underlying unit economics, they'll have demand from the public markets to go public and access that. And there's going to be some management teams that have reasons they want to do that. It can be very helpful to have currency in terms of public market stock to offer employees and to offer potential acquisition targets. I've seen companies that like to be public because their customers are public. And so if you have customers, if you're an enterprise software company and you're serving mostly the Global 2000 or Fortune 500, there is a benefit of approaching your customers and saying, hey, we're a public company as well. We know what that's like. We know how to operate in that environment. I think you're going to have other companies that see tremendous benefit in being private. There are companies that might want to make bold bets as it pertains to investment in research and development, and the public markets may not necessarily tolerate the scale of those bets. So I think you'll see companies that sort of go in the direction that's best for them. And that development of the capital markets means, from an investment perspective, you need to be able to be nimble, to be able to work across the private and public landscape, and to find opportunities to find a way to serve those entrepreneurs in a way that best fits their business.
Yeah, that definitely resonates, having been a little bit in both, working for a public company that acquired private companies and seeing that different mindset. So focus on quarterly versus private companies maybe have a longer time frame. They take bigger bets and so on. And so to that, with an eye on public markets, we've had a more challenging exit environment recently. So fewer IPOs this year. I think we came into the year fairly excited that we might have an unlocking of a lot of value in terms of IPO exits, maybe strategic buyouts. We've not seen that really come to fruition yet. Perhaps that's happening to a lesser extent in AI and technology, where there's still a lot of activities, a lot of excitement around the technologies being developed. So how's that affecting the way you think about underwriting risks, holding periods of companies, looking at that exit environment?
Yeah, whenever we look at investing in companies, to some extent, it's a bit like Groundhog Day, where you're doing a similar set of activities when you evaluate companies, and then of course you're applying a flair to evaluate each of those companies idiosyncratically. But fundamentally, we're looking at a similar set of characteristics for any company we invest in. We're thinking about the addressable market. Is it a large addressable market? Is there secular growth in that addressable market? Two, we're looking at the competitive dynamics of the industry. Is this an industry that's likely to consolidate, where there's an opportunity for market leadership, or not? Some industries lend themselves to fragmentation. Other industries lend themselves to the opportunity for companies to emerge as a true leader in the space. And then, of course, importantly, we're looking at teams. We're looking at the motivations of the individuals at those organizations, the founders, the management teams, the decisions they're making, the way that they're bringing their products to market and thinking about developing new products and serving their customers. So all of that is regardless of what sector a company's in, those are the same types of activities we're looking at when we evaluate investment opportunities. Of course, when you think about building your detailed financial model for any given investment opportunity, at the end state, you have to think about what is the eventual outcome for my investment, right? Is this company going to be a public IPO? And that's how eventually, as a private investor, you'll get liquidity and then potentially sell down your shares over time. Will this be an acquisition target? And what I'll say is, you do have to be really scrutinous in today's environment for which of the two that you're underwriting and why you're underwriting the opportunity in that manner. As it pertains to public companies, we do think the IPO window is open for great companies. Those companies, you have to really understand who is the public market buyer, right? And what are they buying? Are they buying a growth story? Are they buying a profitability story? Are they buying a resiliency story or a uniqueness story? And so it's very, very helpful to understand what is the public story around this opportunity. And there are some companies that have wonderful public stories and others that don't. And then as it pertains to M&A, they always say that companies are bought, not sold. And I've always found that when you enter an investment opportunity thinking, this is going to be so amazing, we're going to sell this company and we're going to walk away and everyone's going to do so well, that can be tricky versus focusing on building a great company. And if you build a great company that has lots of opportunities because you're growing, you're serving your customers well, you have great underlying unit economics, almost inevitably strategic buyers end up knocking on your door and saying, hey, have you ever thought about having a conversation with us and what are your plans for the business? So what I'll say is we look at all companies, regardless of the sector, in a fairly similar way. And we debate this at our investment committees and really get into the weeds of what is the opportunity with this business and will it eventually be an IPO or will it be M&A? So that's kind of how we approach the market, I would say, from an investment landscape perspective.
You're thinking about exits at a really early stage, but fundamentally aiming to buy great companies. And then if we think about at that exit stage, the pricing question right now, how do you think about pricing in today's environment with valuations having come down from the highs in 2021? Have they come down? Is there more of a reset to happen in the venture markets particularly? And what are some of the biggest risks you're looking at right now in terms of macro, competitive, or even technology risks?
Yeah, it's a phenomenal question. So if I take us back to 2021, obviously in the later months of the year and then into early 22, January and February, the markets dropped precipitously, right? On the public side, public stocks came in, 40%. And on the private side, in many ways, it felt like the music kept playing and a lot of the private landscape was partying on. And it was a very difficult environment to deploy capital in 22 and 23. One of the reasons for that was that, the companies that had a lot of success, they raised in 2021, they raised at quite good valuations. And there was not any incentivization for those companies to raise subsequent rounds unless you as an investor came along and said, hey, I'm going to offer you what I think is a really premium valuation to incentivize you to take on capital that ordinarily you might wait to raise a subsequent financing round. So I'd say 22 and 23 were nuanced times, very difficult times to deploy capital. What I found and we found as an investment organization in 24 and into 25 is the markets at the later stages are rationalizing. I think that's very healthy for all participants. It's healthy for investors. It's healthy for founders. It's healthy for employees of companies that ultimately are the ones, working day in, day out to drive these businesses forward. And we're seeing opportunities in the private markets where the pricing looks more similar to how you would price a public market company, but the growth in the private markets is much more aggressive right now, by and large, in the growth in the public markets. So there's almost no companies in our coverage universe on the public side that are expected to grow durably 30% plus for the coming few years. But there's many companies on the private side that are growing, 30, 40, 50, even 100%. Our portfolio within Growth Equity Partners is growing 50% in 2024 and accelerating here into 2025. So I think that's a very healthy environment that we've seen in terms of valuations resetting and companies starting to evaluate, if I do want to go public, if I eventually want to be a public ready company, I have to have a valuation that reflects that. I think ultimately, it's the old adage, right? In the short term, markets are a voting machine, and the long term markets are a weighing machine. Any company, regardless of the product they serve, when they go to the public markets, they're evaluated on, fundamentally discounted free cash flows, on the durability of their growth and the terminal margin structure of their company. And we think it's very healthy. It's a healthy market environment right now that people are back to focusing on fundamentals.
Yeah, fantastic. Are there certain themes or sectors in today's environment that you find particularly compelling right now?
Yeah, of course. I would say generally speaking, we look very closely. We spend a lot of time in enterprise software, enterprise technology. And whenever we look at enterprise technology, we look at these quarterly surveys of where technology leaders are spending their dollars and spending their time. And almost it seems quarter in, quarter out, the same sectors ding up as, areas of budgetary growth, areas of resilience. And those are really today AI, data infrastructure, and cybersecurity. Those are areas we get extremely excited about for different reasons. But I would say the budgetary growth in those areas is just phenomenal. And generally speaking, those are areas where there's a ton of excitement, a lot of innovation. And ultimately, again, our business is in part about following the people and the entrepreneurs in those spaces. I think because the market opportunity is there and because there's so much pull in the market, it gives them a little bit of space to be creative and to build exciting companies versus other industries that may be more in retrenchment mode. It's very hard as an entrepreneur to operate in an environment that's in retrenchment mode versus the areas that I mentioned. It's kind of a rising tide lifts all boats type scenario.
And so with that rising tide, and when you say budgetary growth, you mean in terms of enterprise software, companies are interested and willing to spend more on AI, on these themes, taking kind of experimental bets, or maybe believing fully in AI and committing to large scale investment. Is that kind of the dynamic that you're seeing is causing this excitement?
Yeah, let's use AI as a great example. We get excited about AI like everybody else. I mean, it's amazing to think, ChatGPT just came out in November 22. So there's a huge amount of excitement and recency with AI. But traditional technology, so if you look at worldwide IT spend per Gartner, that sector is $5 trillion of spend relative to $110 trillion global economy. So despite the fact that we spend a third or half of our waking days on devices in front of screens, the tech spend is still lagging, right, at only 5% of the economy. And that's why we say technology growth is a secular opportunity. It's not a sector-specific opportunity because there's going to be so much growth as the budgets match where we're actually spending our time. AI really gets into those sort of core workflows. So of the 110 trillion of global GDP, 70 trillion is labor. It's people working and going to their jobs, and AI can get into those workflows, right? And to start to say, well, how do I, especially, let's take an environment that's a workflow that's information dense, that's a lot about searching over information, retrieving information, packaging it up, communicating it, things like financial services, industries like law, government. I mean, there's a massive opportunity within AI to go from being siloed within the $5 trillion of tech spend to really entering that $70 trillion of labor spend. And so that's going to be, in our expectation, a huge area for budgetary growth because anybody, whether you're a small business or large enterprise or even an individual, you're looking for ways to sort of have better productivity, to have more efficiency. And that to us is going to lead to a lot of spend and a lot of definitely experimentation. And so that's where for us, it gets into the scrutiny of, is this experimental budget or is this durable budget? But we think there's going to be large swaths of durable budget, across the spectrum.
Yeah, real use cases are being found and invested in.
100%. Yeah.
Great. So you've throughout your career, you've invested in, analyzed a number of companies. I'd love to wrap up with any personal lessons you've learned throughout the course of your career.
Yeah, I'll tell a story because I think it's a great story, and sometimes these concepts are best communicated through a story. So earlier in my career, I was, there's two companies, Company A, which is the incumbent technology in a space, and Company B, which is the fast-growing attacker. And I was looking at evaluating Company B, the fast-growing attacker. And I was able to get a meeting with actually one of the co-founders who's a luminary of Company A, the incumbent in the space, who had since left the business. And I got an introduction and I spoke with him and I said, hey, I'm looking at evaluating a business that's competitive to the one that you founded. I'd love your insights. Like, what do you think of them? And he sort of, he's not a person of many words. So he paused and I was kind of leaning in like, okay, what's the secret sauce? What is he going to say? And he said, they're excellent. And I said, well, can I double click on that? Like, why do you say that they're excellent? And he paused again and he said, if you watch the moves that they're making, the products that they're shipping to consumers, the way that they're going to market, they're really doing things in a very intelligent way. And that makes me believe that they have excellent people working at the company. And any company is just a collection of its people. I thought that was a really profound sort of understanding of this company. By the way, Company B has since gone on to like be a 20x from where I first looked at it. It's now in its own right a large public company today. Right. But I think as an investor, the most important thing that I've learned is you can look in spreadsheets, you can do all the analytical work that you'd like, right? And you can analyze reams and reams of publicly available data and private data specific to companies. But at the end of the day, any company is a collection of its individuals and its culture and its people. And the best companies, they find a way, right? They tend to have Act 2 and Act 3, and they push and they push and they push. And when you've seen companies at the earliest of stages trying to bring this very fragile idea into the world, and you see how they grow and develop and they land and they build customer accounts and they build relationships with customers, and those relationships turn into increased commercial relationships, and that enables them to recruit even better people and they level up. Those are just the excellent companies. And it's very easy as an investor to get caught up in the numbers and to the point that you made earlier, the latest quarter and what's the linearity in the quarter and how are we trending? But often the best companies, they just find a way and it's nonlinear, and they're doing so because they've got these amazing people, these visionaries who see around the corner and they recruit other incredible people. So I've spent a lot of time in my career around companies, and the more time that I spend around companies, I just appreciate how difficult it is to bring a company from nothing and to go all the way, to go the distance to become a public company. And often it's everything comes down to people at the end of the day.
Well, that's a great note to end on, Paris. I love that even at this large scale level, it's still about the founders, the people, the relationships that they're building.
100%.
Paris, this has been a really great discussion on the venture and the growth industry. Thank you so much for joining me on Alternative Realities and sharing your experience and insights with us.
Awesome. Aaron, thanks so much. It's been a pleasure.